Did you know that not all of your FERS annuity is taxable at the federal level? Some people don't know that. Let me explain it. Stick around. Welcome back, FERSonians. I'm Chris Barfield, barfieldfinancial.com. Today we're going to be talking about your 1099-R that you get if you're retired or you're getting ready to retire. This is something that you're going to want to know. Some of you are out there. I posted this on Facebook and found out already that a couple people have been paying more taxes than they were required to. You never want to do that. You don't want to pay less than you're required to, but you certainly don't want to pay more than you're required to. Let me back up a little bit to lay the foundation because I really want you to understand this. When you are working under FERS, you are paying into your retirement system every pay period. Some of you may not know that. Hopefully you do. Might come as a shock, but it's not free. Your pension isn't free. You are going to have to pay for that. Depending on what job you do and when you were hired, you could be paying anywhere between 0.8% all the way up to 4.9% every pay period. It's a big range in there, depending on, again, what you do and when you were hired. We don't have time to go into all that. But you're contributing that money towards your FERS pension, your FERS annuity. That money goes into an account. Once you retire and you start getting your monthly check from the government, when they pay you to not show up anymore, you're going to be getting a check from them first of every month. Part of that money is your money coming back to you. It's not all from the government. Part of it is just your money that you've paid in. You're getting some money back. It would not make sense, even for our government, to tax you twice on that. You already paid taxes when you contributed that money because it's after-tax payments that you're making every pay period. So when you get your money back from the government, a check, part of that check, a very small part, is not taxable. So you should not be claiming the full amount on your tax return every year because it's not all taxable. Let me show you what I mean. Okay, here I've pulled a 1099-R. You can see that up here, 1099-R. That's what you will get when you're retired and you are getting a check. They're going to report. You'll get one of these January, February or so, reporting how much retirement payments you received from the year before. I think I'm pretty sure I removed everybody's, whoever this is, personal information. The important part here is the gross distribution. This is the gross amount that you were paid. This is the maximum amount. So this would be your annuity. And if you have a supplement too, this person's getting almost 75,000, 74,000. Here is the taxable amount. This is the part that you should claim on your taxes. Not 74,000. A part of this, let me see, roughly, that's about $1,000, a little more than $1,000. So if you're claiming 74,000, you're claiming too much because only 73,000 of it is taxable. Some people have told me that they thought this was the amount, the deduction for health insurance or something like that. That's not the case. The amount that you're paying for health insurance is over here. Insurance premiums. This person's paying $100 or so a year, at least for this year that they paid. That, obviously, if you do the math, that's not the difference in the deduction. So a portion of the money that you paid is coming back to you. That is not taxable. If you look down here, you'll see your total employee contributions. This is what I was talking about. This individual paid over their FERS career roughly $32,000 towards their pension. So over time, they will recoup that $32,000 every year until it's exhausted. And this is the difference here. So claim the taxable amount. This is not tax advice, by the way. Please speak to your CPA, whatever tax pro you're using. This is just to help you educate them maybe or have a more intelligent conversation with them about your taxes. Okay, here's another person's 1099. We've got a similar situation here, except that in the taxable amount, we have the word unknown. In other words, for whatever reason, OPM could not figure out this person's taxable amount. You'll see down here, there's not a total employee contributions. So somewhere in the record keeping, there is some issue here. It could be that they just retired, because you see this distribution for the year is not very much, $4,300. That's low for so this person probably retired towards the end of the year, and for whatever reason, all of the paperwork wasn't done. Regardless, the amount that is taxable is unknown. So this person has two options. One, they could pay, or they could just claim the $4,300 as taxable income, although it's probably not all taxable. The other option that is available to them is you can figure it out yourself. Now, I'm going to warn you up front, this is not fun. Now we're delving into the world of the Internal Revenue Service. But the IRS publishes a booklet that is just for us as federal employees. It is called Publication 721. IRS Publication 721. IRS names their publications just like after numbers. So the one that we are concerned about is IRS Publication 721, which is a good resource, by the way, incidental to all of this. It talks about TSP and some other tax things that are very unique and specific to us. It's written just for us, so it's something you should be aware of. Let's take a look at the IRS Pub 721. If you just Google that, you Google that term, IRS Pub 721, this will come up. There's all kinds of information in this. Don't want to bore you to death. But if you come down here, rules for retirees, recovering your costs tax-free. I'm not going to delve greatly into this. For those of you that want to do this math, you're inclined to go learn this on your own. You don't need me. For those of you that aren't going to do this math, no amount of me trying to convince you is going to make you do the math. So it's pointless to go too far in depth into this. But we come down here to the simplified method. That's what it's called. And it helps you figure out, there's a worksheet here. You can go through this. You can spend your time doing it, showing you how much of that amount is taxable. So if you want to come up with the number yourself, make sure that it's done right. You can do that. You can also just dump all this. This is what you should do. Dump it all on your CPA and let them figure it out. I have had a couple of instances in the last week, though, where the CPA did not fully understand this. This is why it's important to try to find a CPA that's at least somewhat familiar with FERS. They didn't fully understand this, and they claimed the full amount, the gross amount, as taxable. So that individual paid a little bit more in taxes than they should that year. If it was $1,000 and they're in the 22% bracket, then that cost them $220 more in taxes, which was probably close to what the CPA charged them. So he should probably refund them their fee or something along those lines. But regardless, don't pay more taxes than you should. So again, this is where we would use this information. If you have an unknown, you can give it to your CPA. You can try to delve in IRS Pub 721 and do the math yourself. But regardless, bottom line to all of this is not the taxable amount, box 1. The taxable amount is in 2A, and it is based on what your employee contributions were. We'll go back to one that actually has employee contributions, so you know what I'm talking about. But just understand, bottom line to all this, oversimplification, don't claim the full gross amount if the taxable amount is less. Because remember, you are getting some of your own money back. Hopefully that helps provide some insight into your taxes in retirement. They are very complicated in retirement. They're complicated all the time, but particularly in retirement. The onus is more on you to make sure that things are done properly. It's not as automatic as while you were working. So take this knowledge, discuss it with your CPA, and don't pay more taxes than you should. Follow barfieldfinancial.com for more information. And until next time, feed your TSP.